Yes, hello and welcome to the notes on the analyzing and reporting process. So what we're going to be talking about in this chapter is we're going to be talking about how to do some basic journal entries. We'll review the accounting equation and talk about how to journalize, do our journal entries in our general journal, and then also post them to our journal ledger, and then prepare a trial balance, and then also do a trial balance, an unadjusted trial balance, and then prepare our financial statements, our income statement, and our statement of owner's equity, and our balance sheet from the trial balance. Okay? So with our journal, with accounting, what we have is the first thing that we're going to be doing is analyzing a transaction or some event. And the way that we can get the information about the transaction and then the event that occurs within the organization is by inspecting our source documents. So that gives us a lot more information about what's exactly happening. So a source document identifies and describes transactions. It's a source of accounting information. So for example, we've got a check would be an example of a source document, purchase order, an invoice from the supplier. We could also say a bank statement. So all these can help us give a little bit more detail that we would need to do our journal entries and analyze exactly what happened into our journal entries and then post to the journal ledger and eventually get into preparing our financial statements. So some other terms that we have to talk about is the idea of an account. So an account is just a record of increases or decreases in a specific asset. We have a cash account. We could have accounts receivable. The general ledger is a collection of all the accounts and then the respective balances used by the entire company. So one of the things you should remember from our first lecture is talking about asset accounts. So asset accounts are assets are owned by the company, and they're expected to have future benefits, to provide some benefit to the company now or later on. So examples of asset accounts, some common examples that we'll talk about in this lecture right here are cash accounts, accounts receivable. So cash, that's pretty straightforward. Our bank accounts, for example. Accounts receivable. So an accounts receivable, remember that what that is if we make a sale on credit. So our customer has not paid us yet. What we have is an accounts receivable. We can also have a prepaid expense, so prepaid insurance. We could have prepaid rent, which is a temporary asset, and then once we actually go through and use that insurance, once the insurance has expired, we would debit insurance expense and then credit the prepaid insurance or prepaid rent. Supplies is another asset. We also have equipment. We can also say notes receivable. So those are assets. So again, assets are something that we own, provide some economic value. Okay. We can also have liabilities, which are claims by creditors against our assets. So it's something we owe. So liability can be in the form of we owe cash, or we have a notes payable. We have to eventually pay that back. But we could also have an accounts payable, and accounts payable are used for purchasing supplies or purchasing inventory. Typically don't have interest. Notes payable would have interest. It involves a promissory note as well. Unearned revenue is a liability in which we actually get paid up front, but then we actually have to perform the service. Okay, so it's unearned revenue, or also known as deferred revenue. So what I was saying earlier about liabilities, it's something we owe. So it could be cash that we owe, but it could also be that we owe a service. So an example of unearned revenue, if we have prepaid legal fees, we're a law firm and somebody pays us up front for legal fees, and we haven't provided the legal services yet, that is a liability. And then once we perform the legal services, we can recognize the revenue and then reduce the liability. Okay? We also have equity accounts. So equity, so again, if we take our accounting equation down here, assets, and we divide it between liabilities and equity, so liabilities, and we look back up here, is claims by the creditors against these assets. Equity is the amount of these assets that the owners claim, the owners claim on those companies' assets. Okay? So if we look down here, this is something we have talked about before, that equity has four components that positively or negatively affect equity. So owner's capital, which should be owner investments, so owners invest money into their company, right? That would be a positive impact on equity. Owner withdrawals, owners taking money out of the company to pay personal expenses, that would be an owner withdrawal, and that decreases equity. We also have revenues, and revenues positively influence equity. An example of revenue would be sales, or we could also say interest revenue. Expenses decrease equity. So expenses such as cost of goods sold, or rent expense, or insurance expense, those all decrease equity. All right. So let's take a quick look at these quick check problems right here. We can say our source documents include all the following except VER ledgers. So sales tickets would be an example of a source document. Checks, purchase orders, and bank statements. A list of all accounts and then the identification number assigned to each account used by the company is called a chart of accounts. Okay? So let's talk a little bit more about the chart of accounts right here. So remember, the ledger is a collection of all of our accounts. So cash, accounts receivable, accounts payable, notes payable, and then their respective balances. So what is our balance in cash? How much cash do we have? How much outstanding accounts payable do we have? That would show up in the general ledger. The chart of accounts lists all of our accounts. So it lists as cash, accounts receivable, and then it has a number by each account. So that's how we're going to reference all of our account numbers. So if we look over here, here's an example of a chart of accounts. So we can see we have account number 101, that's cash. 106 is accounts receivable, 126 is supplies, 128 prepaid, 167 equipment, so on and so forth. Okay? So this is our chart of accounts. Let's talk about the essence of journal entries, which is debits and credits. So with debits and credits, if we can represent an account in the journal ledger with the T account right here. So this could be like cash, or we could say it's also accounts receivable, okay? Or we could say it is accounts payable, okay? Whatever we want to call it. And what we're going to be doing, this is not a journal entry. This is not a journal entry back here, okay? Well, this is a T account that visually represents an account, okay, and its respective balances. So what we would have right here with cash, we would say, okay, we have all the debits of cash, which would be showing up on the left side. All debits show up on the left side of the T account. All credits show up on the right side of the T account. Okay. So one of the ways that I remember debits and credits is to think about it in the accounting equation like this. So we have our accounting equation: assets equals liabilities plus equity. Okay. Debits increase assets, and debits decrease liabilities and equity. Credits increase liabilities and equity, and credits decrease assets. If you can remember this, and you can classify, and you can analyze the transaction and say which accounts are being affected, and then you can classify each account as an asset, liability, or equity account, then you can do any journal entry. Okay? So again, let's recap really quickly. So a T account right here visually represents different accounts in the journal ledger. And so we could say it's cash, accounts receivable, and it's showing all with cash, since cash is an asset, all the debits are increases in cash, and all the credits to cash are decreases in cash. If this had been the account title or accounts payable, all the credits would be increases in accounts payable, because the way I increase accounts payable is a liability, and the way I increase the liability is with the credit. So all credits are increases to accounts payable, and all debits would be decreases to accounts payable. Okay? One of the things about doing journal entries is that each journal entry that we do, we're going to be talking about journal entries here in a second, requires a debit and a credit. And the sum of the debits for each journal entry must equal the sum of the credits. Okay? If that is not true, then this accounting equation, which needs to stay in balance, if the debits don't equal the credits, this will not be in balance. It will be unbalanced. Okay? So if we look over here, this diagram gives some more detail, kind of similar to the diagram that I just talked about. With our assets, debits increase assets, credits decrease, and then same with liabilities, credits increase liabilities, debits decrease liabilities, credits increase equity, debits decrease equity. So we think over here and we look at our asset accounts and we say, well, what should we normally have with an asset account? Should normally be a debit. Okay? And the normal balance, what we should normally see for accounts payable, is a credit balance. And the normal balance that we should see for owner's capital, which is an equity account, is a credit balance. Okay? And I'm going to come back over to my other page right here. Now I'm going to go through and classify all these accounts as assets, liabilities, or equity. Okay? So that is an asset. That is an asset. That's an asset. That's an asset. That's an asset. This is a liability. That's a liability. This is equity. That's an equity account. And then these are all components of equity. Okay? These all affect equity. Okay? They all affect equity. Okay? But they don't show up on the balance sheet. They show up on the income statement. But they do affect equity. Okay? And this is basically what I've just been talking about before with the four components of equity. So we look over here and we say, okay, owner's capital positively affects equity. So if owners invest more money into their business, owner's capital goes up, that means equity goes up. So how would we recognize, therefore, that owner's capital would go up is with a credit, because credits influence equity. So it starts here and then flows to there. Okay? Owner's withdrawals, they decrease equity. So let's look here. Owner's withdrawals, to show that an owner took money out of the company, we would debit owner's withdrawals. And why would we debit owner's withdrawals? As owner withdrawals goes up, that's recognized with a debit. Owner's withdrawals goes up, equity goes down. How do I make equity go down? With a debit. So remember, this flows through. Okay? We have revenues right here, such as sales. We make a sale. We know that revenues positively influence equity. So as revenues go up, equity goes up. So therefore, how would I recognize a sale with a credit? Okay? How do I recognize an increase in revenues? So for example, a sale, it would be with a credit, because then that flows through and increases equity. Expenses, finally, how do I recognize an expense or expenses going up? I recognize that with a debit, because as expenses go up, equity goes down. How do I make equity go down? With a debit. Right? We look over here and we can say the account balance in our T account. So again, this is our cash balance. This is our cash T account. And again, this would be simulating what we would see in the journal ledger. You can do that with the T account right here. So you can see these are all increases, because I know this is cash and cash is an asset. Therefore, debits are increasing cash, because the way I increase an asset is with the debit. And you can look at this, the description. Receive investment by owner, $30,000, cash is going up. Consulting services earned, cash is going up. Purchase, I had to pay something with cash. So these are the credits, these are the debits. Okay, so this is the decreases in cash, these are the increases in cash. The way I get my I'm trying to read that. I think it says $4,800 is I would add up all my debits and subtract my credits. If this had said accounts payable, where the normal balance would be a credit, I would add up my credits and subtract my debits, and I would expect to have a balance over here on the credit side, if this had said accounts payable. Okay? So now let's talk about journalizing and posting transactions. So our first step, again, is we're going to be analyzing our transactions and our source documents. We're going to be applying our double entry bookkeeping. We're going to be doing our journal entry, and then we post our journal entry to the general ledger. And so we're going to be talking about that in more detail now. Okay, so let's talk about our journal. So our general journal is going to be keeping track of all of our journal entries. So this is exactly what it looks like. So we say right here, December 1st, our owner invested $30,000 cash in his business. So we would go through here and we'd say December 1st, cash, debit to cash. This is a debit, okay? This is a credit. So I list my debits first, and then I indent and I show my credits. And I can also do it over here. When you do your journal entries, you don't actually have to show that. All you have to do is just go cash, indent, and credit. Okay? So I know that the credits are indented. Same thing here, December 2nd. I bought supplies for cash, so supplies is going up by $2,500. And then see, cash is credited, so cash is going down $2,500. Okay? So then what I can do is I come over here. So this is This is called journalizing. This is our general journal. So we have some transaction, we record it in our general journal, and then what we do is we come over here to our general ledger. Okay? So it says right here our balance column account is just like a T account, and this visually represents the journal ledger. So you can see it's account number 101, which is cash, and then look. So we come over here and we say description, debit, 30,000, and this is called post reference, which this G1 stands for general journal page 1. So it's referencing this journal entry right here. Okay? So initial investment, $30,000. Here's my balance in cash. And then you can see the second one, December 2nd, that decreased supplies by 2,500. So I say purchase supplies, general journal page 1, credit 2,500, 30,000 minus the 2,500 gives me $27,500 left over. Okay? So basically that's everything. This is simulating our general ledger right here. Let's go ahead and jump on to page 29 of this course pack right here. We're talking about our owner investing money into the business and analyzing some different transactions as well. Let me catch up. So, owner invests $30,000 in Fast Forward. Fast Forward is a company on 12/1. So we do our analysis and we say what things in the accounting equation are being affected. And if I come back over and I look at my prior page where I have my chart of accounts, this is going to help me out. I can say, okay, what things are being affected? Well, assets are, because cash is going up. He's investing cash. So assets are going up. Liabilities are not being affected at all, but invest money, what's going on is that owner capital, C. Taylor Capital, the owner is C. Taylor. C. Taylor Capital is also going up, so that means equity is going up. Okay, so I'm analyzing which things are being affected. Okay? The next thing I'm going to do is I'm going to do my journal entry. So I'm going to come over here, I'm going to put my date of 12/1. Not going to worry about the description, but I am going to do my debits and credits here. So what I do is I look over here and I say, okay, what things are being affected? Cash and owner's capital. Where do I classify cash? It's an asset. Cash is going up. Cash is an asset. How do I show that an asset is going up? With a debit. Because remember, this okay? So how do I show that an asset is going up? With the debit. So I debit cash for $30,000, and then what else is going up is equity is going up, and specifically Taylor Capital is going up. How do I represent that? With the credit. So I would credit C. Taylor Capital $30,000. Right? Then I come over here and I do my posting, and what I can do is I can do my T account. So I say cash, I'll say 1, because that's the first journal entry, 30,000. I can come over here and say C. Taylor Capital 30,000, and that's 1. Just to show that it's on 12. Okay? Or it's the first journal entry that we do, just so we can keep track of it. Let's look at the next one that we have right here. Fast Forward purchases supplies by paying $2,500 cash. What is going on right here? In this case, there's no effect on the right side of the accounting equation on liabilities and equity at all. The only thing that's being affected is assets. And what's happening, right, is that supplies are going up because I purchased supplies by paying $2,500 cash, and then cash is going down. $2,500 per book. Okay? So actually, how do I do my journal entry? I come over here and I debit supplies for $2,500. We'll say that's on 12/2. I debit supplies for $2,500, and I credit cash for $2,500. Okay? I can go through with my postings, and I can say my cash. I can say my supplies. And recall back up here, we had our 30,000, right? Now I have 2,500. So I can go through and I can actually calculate out my balance in my cash account by saying my 30,000 minus my 2,500 gives me my 27,500 right there. Okay? So now let's go through and look at the next one that we have, which is number 3. Fast Forward purchases equipment by paying $26,000 cash. It's the same deal as the supplies in the sense that this is not being affected. The only thing that's being affected is assets. So cash, equipment is going up and cash is going down. Okay, so the journal entry would be a debit to equipment, which is an asset. That is something that we would own and gives us some economic benefits, $26,000, and a credit to cash for $26,000. And then when we post it, we have our cash right here, and we had our $30,000, and then we had our $2,500 that we paid for supplies back in the example 2, and then what we have is our $26,000. And you can go through and calculate out how much cash you have left over. Running out of room, but it'd be $1,500 cash that you would have left over. Okay? We can do the same thing here for equipment. And we would just say $26,000. Okay? Look at example 4. It says Fast Forward purchases $7,100 worth of supplies on credit. So what this means right here, this is accounts payable. Okay? They put it onto the credit card. So they did not pay cash. And if you think about it, why didn't they pay cash? Well, how much cash do they have left? $1,500. They don't have enough cash to buy all these supplies. Okay? So what they would do is put it onto accounts payable. So if we look at here, what's going on with our accounting equation is that supplies are going up, and then also accounts payable, which is liabilities. So equity is not affected. Not affected. Liabilities are going up by $7,100 because accounts payable. And supplies, which is an asset, is also going up by $7,100. So we come over here and go debit to supplies, $7,100. Credit to accounts payable, $7,100. Okay? I can come over here and do my T accounts to simulate the postings. I have supplies. And then I have accounts payable right here. So I have my $2,500 that I had in my example 2. And I also bought another $7,100. Okay? And I can come over here and just $7,100. If you wanted to put in the account balance, you could. You just add these. You would just add these two together, of course, for accounts payable. This would be $7,100. Okay. So now let's look over here at example 5. It says Fast Forward provides consulting services and then immediately collects $4,200 in cash. So let's analyze what's going on right here. Well, we know right here that cash is going up. Okay. Okay. Liabilities are not being affected, but equity is also going up by $4,200 in the form of revenue. Okay? Because we provided consulting services. Right? So consulting services revenue is going up. All right, so if we can go ahead and do our journal entry, we would debit cash of $4,200, and then we would credit consulting services revenue for $4,200. And then if we think about our posting here with our T account to simulate our accounts in our general ledger, we have cash over here. Remember what we had was $30,000, right? We have the $2,500 over here. We have the $26,000 here, right? But now what we're doing is we're adding $4,200 right there. So now take a second and go ahead and calculate out the cash balance. Okay. Well, I hope you got $5,700. That would be debit balance. That would be the balance of cash. And then we can say our consulting revenue. Come back over here and we know it's going to be $4,200. Alright, so go ahead and try to do these quick check problems, and then we'll come back and check it. So if you go ahead and try this on page 31, or let's see, 31, 32, 74, all the way up through number 92, and then we'll talk about the trial balance, and then we'll do some extra problems as well. Alright? All right, so welcome back. Let's see how you did. So it says, which of the following statements is incorrect? The normal balance of an accounts receivable is a debit. That is true because accounts receivable is an asset. The normal balance of an asset account is debit. The normal balance of owner's withdrawals is a debit. That is also true because owner withdrawals decrease equity. The way I decrease equity is with a debit. The normal balance of unearned revenues is a liability. Liabilities normally have a credit balance. The normal balance of an expense account is a debit. That is a credit, sorry. That is not true. It should be a debit because expenses decrease equity, and the way I decrease equity is with a debit. The normal balance of owner's capital is a credit. That is true because owner's capital positively influences equity, and the way I make equity go up is with a credit. Okay. Let's look at number 74 right here. It says a credit is used to record an expense, an increase in expense account. No, that would be with a debit. A decrease in an asset account. That is correct. A decrease in unearned revenue. No, a credit increases unearned revenue. Okay. A credit is used to record a decrease in revenue. No, a credit would be an increase in revenue. Okay. And then same thing, it would be an increase in the capital account because this and this both positively affect equity. And the way that I make equity go up is with a credit. Okay? This is a liability. And liabilities normally have credit balances. So if I credit unearned revenue, it's going up. Okay? Let's look at number 82 right here. Rocky Industries received its telephone bill in the amount of $300 and then immediately paid it. So what we would have is a debit to telephone bill expense and then a credit to cash. That would be the journal entry. Okay? So the right answer would be A. It would also be a credit to cash. All right? So let's analyze why some of these other ones are incorrect. Credit to accounts payable. No, that would mean that if they didn't immediately pay it, if they were going to pay it later. Debit to cash. A debit to cash for $300 means cash is going up. Cash is not going up. It's going down. Credit to telephone expense. A credit to an expense would mean it's going down, but that's not what's happening. We're recognizing the expense, so the expense is going up. Debit to accounts payable. We would debit accounts payable when we pay off the accounts payable, and that has nothing to do with what's going on here at all. Okay? Look at number 88 right here. It says on September 30th, the cash account of Value Company had a normal balance of $5,000. During September, the account was debited for a total of $1,200 and credited for a total of $11,500. What was the beginning balance in cash? So we have his cash right here. And what we have right here, let's see, we have $12,200, credited for $11,500. And then at the end of the month, we have it $5,000. So what we're looking for is beginning, which is our unknown right there. Right? And hold on, I have to get a new pen. Okay, I'm back. So our beginning, so what we can do is we can say beginning, which is X, plus 12,200 minus 11,500 equals 5,000. So we're just setting a pretty simple algebra equation right there to solve for X. So when you solve for X, what you get is 4,300. Let's look at number 90 right here. So it says during the month, Hoffer Company had cash receipts of 7,500, cash disbursements. So cash receipts means debit to cash, cash disbursements means credit to cash. So let's look at our cash account right here. So we had 7,500. So I'm asking what was the January 31st beginning balance? So beginning balance for the beginning of February, basically, because the end of January becomes the beginning of February in terms of the balance for cash. So we say right here is we have our beginning, which is our unknown, represented by beginning or beginning X, however you want to say it. What we have is we have cash receipts, so those are debit to cash right here. Cash disbursements, credit to cash. We have our ending balance of 1,800. Solve for beginning right here. So we can say our beginning plus 7,500 minus 1,800 equals, minus 8,600, sorry. equals 1,800. There we go. And when you do it, there we go, sorry about that. And when you actually do the algebra, what you get is C 2,900. The last one right here, and this one's kind of a confusing one, is Tim Jones uses cash to purchase the family automobile. He can't do that through the business because of the business entity assumption. That we're going to be keeping track of the owner's personal finances separately, owner's personal accounting separate from that of the business. So what Tim Jones has to do is withdraw money from the company. So we would debit withdrawals, and then we credit cash. Crediting cash means cash goes down. Debiting withdrawals means equity goes down. Withdrawals have a negative effect on equity, and that's why our withdrawals are debited. Okay? So let's talk about the trial balance. So what we're going to do is at the end of the accounting period, we're going to prepare our trial balance. And so with our trial balance, what it's doing is it's listing all of our debits and all of our credits. So we're pulling these dollar amounts right here, cash. We're pulling that from the journal ledger. Accounts receivable, there is nothing. Supplies, we pull that from the journal ledger. Prepaid insurance, we pull that from the GL, the general ledger. Same with equipment. And we put it into its respective column as debit or credit. We add it all up, and they need to equal. Because if they don't, the balance sheet will not balance. Okay? So basically everything that I was just talking about here is explained here in a little bit more detail. Preparing the trial balance, list each account title, its amount in the trial balance. Okay? Compute the total debits and the total credits and make sure that they equal. If they don't equal, right, the first thing that I would do is make sure, did I add up all these right? Then I would go through and make sure, okay, did I put one of these in the wrong column? So I would search for the high-level errors first and then drill down. So after I did that, after I made sure I added up all right, put it in the right column, then I would say, okay, is this cash right here, is that really what's in the journal ledger, or did I copy it wrong? Okay? That's the next thing I'd do. And then after that, I might then have to go back and check the actual journal entries, but I would do that last. Okay? So let's jump over here to talk about using a trial balance to prepare financial statements. So at this point, they're unadjusted. We haven't done our adjusted journal entries. We haven't accrued for any revenue, for example, that we haven't recognized yet, or any expenses that we also haven't recognized yet. We would do that at the end of the accounting period, and then at that point, after we've done our adjusted journal entries, we would prepare our adjusted trial balance. Okay? But right now, they're unadjusted. So what we can do is we can use our trial balance to prepare our financial statements, and let's go ahead and talk about that in a little bit more detail. So the first financial statement that we're going to do is the income statement. So the income statement shows exactly what you think. It shows our revenues and our expenses throughout the accounting period. So we have our consulting revenue, our rental revenue right there. Where do we pull that from? The trial balance. 5,800 and 300. 5,800 and 300. Adds it together, gives us 6,100. Come over here, salaries expense, rent, and utilities. Add up all those, total expenses, revenues minus expenses gives us profit. After we do our income statement, we can then do our statement of owner's equity. We can see with our statement of owner's equity, it's just breaking out the four components of equity. So what we have is beginning capital right here, and then we have our net income. And so you might be thinking of, why do we actually have net income? Well, see where you got that number, 3470, 3470 right here. That number comes right there. And you might be thinking, why does that happen? Well, we think about, remember the things that affect equity. Owner's capital, owner's withdrawals, owner's capital, right here in an investment, okay? Owner withdrawals, right here. Revenues and expenses. Those are the other two things that affect equity. Well, revenues and expenses, that number is wrapped up right here, because this is revenues minus expenses. And so I just take net income and then I put it here. That's why I need to do my income statement before I do my statement of owner's equity. Then what I can do is I can do my balance sheet. So I have if I come over here, I have my assets. I'm pulling those numbers, cash right here. I'm pulling that straight from the trial balance. Supplies, straight from the trial balance. Prepaid insurance, straight from the trial balance. Equipment, 26,000 straight from the trial balance. I have my total assets. I have my accounts payable, my unearned revenue, and then here's my 33,270 $33,270. That number flows down to there, and that's actually how I get that. So I could add my equity, my balance of equity right here, plus my liabilities, and that should give me $42,270, which is the summation of my assets, and that's why it's called a balance sheet, because this balance sheet reflects the accounting equation, right? So I'm going to skip this with some of these presentation issues. I'll let you look at that. Why don't we move on to the quick check problems, okay? Take a second and do all these quick check problems, and then we'll go ahead and see how you did. Okay? Well, welcome back. Let's go ahead and walk through all these quick check problems. So if you did this correctly, you would have gotten a C. If you didn't, let's go ahead and talk about it. So what I have to do is basically classify these balances as debits or credits appropriately. So what I have is my cash of $30,000. I have my accounts receivable of $32,000. I have my accounts payable over here of $20,000. I have my fees earned of $65,000. That's on the credit side. This is debit. This is credit. I'm just going through and doing it this way just to show it to you. You'd normally probably want to list them all and then go debit, credit, but I'm just doing it this way. Okay. Then what I have is rent expense, $15,000. I have insurance of $4,800, and then what I have is supplies of $5,000 right there, and then I have my withdrawals of $18,000. And then over here I have my capital of $19,800. And when I add up all these, and I add all these numbers up, and then I add all these numbers up, what I get is $104,800. And then of course over here it's also $104,800. That's the right answer. And then it does balance and move back out. So look at number 19 right here. It says a $15 credit to sales was posted at $150. So it is B overstated by $135. Right? We come back over and look at 126. Which of the following, all the following are assets except accounts receivable, building, yep. Supplies expense is not an asset. That is expense. Supplies is an expense. But once we use supplies, it moves from supplies the asset to supplies the expense. Cash is an asset, so is prepaid insurance. All the following are liability accounts except for accounts payable is, unearned ticket revenue is, taxes payable, anything that says payable is, and then notes payable is, commissions earned, this is not a liability. Right? We look over here at number 152. It says a company sends a $1,500 bill to a customer for delivery services rendered. Set up the necessary T accounts below and show how this transaction would be recorded directly in those accounts. So we have our accounts receivable, and then we have our delivery fees earned. Okay, so we have our $1,500 here, and then what we'd have is $1,500 right there. The journal entry would be a debit to accounts receivable, $1,500, and then a credit to delivery fees earned for $1,500. Now this is the journal entry. These are the T accounts. Okay. Let's look at 156. It says right here on February 5th, Textron Stores purchased a van that cost $35,000. Firm made a down payment of $5,000 cash and signed a long-term note payable for the balance. Come over here on 2.5, and what we would do is debit van for $35,000. Equipment's fine. We'll just say van for now, whatever their chart of accounts is. And then what we have is a credit to cash for $5,000, and then a credit to notes payable for the difference of $30,000. Right? So if you haven't done number 159, take a second and do 159. This, by the way, has nothing to do. That's just a typo. We need to get that out of there with number 159. So take a second and go ahead and do that, and then we'll review it. So welcome back. Let's go ahead and take a look to see how you did. So the first one says, began a financial services practice by investing $15,000 cash in office equipment of $5,000, debit to cash, debit to office equipment, credit to L. Matson Capital $20,000. And you can put in the date, debit, indent, credit, and then here is the actual description of the journal entry. Okay? It says right here, purchase $1,200 of office equipment on credit. So that means going to debit to office equipment, credit to accounts payable for $1,200. Purchase $300 of office supplies on credit, debit to supplies, credit to accounts payable for $300. 12.4, completed work for a client and immediately collected $900 cash. So it's a debit to cash, $900, and then a credit to consulting fees or consulting revenue. I said fees earned, $900. And fees earned is acceptable. Consulting revenues is acceptable. Consulting services provided, those are all acceptable. Some revenue account. Okay? We come over here on 12.8. It says completed work on credit. That means we have an accounts receivable. So that means that we have completed the work, but we have not been paid for it yet. So we debit accounts receivable $1,700, credit fees earned $1,700. Number 10, it says paid for the supplies purchased on credit on December 3rd. So if you look back up here, December 3rd, we paid for these. So that's a debit to accounts payable and then a credit to cash for $300. The 14th, it says paid the $960 premium on the insurance policy. That is going to be a debit to prepaid insurance, credit to cash. It's a prepaid asset. Okay? On the 18th, received payment in full for the work completed on December 8th. Remember, so what's happening is that our customer has paid off their accounts receivable. So it's a debit to cash for $1,700 and a credit to accounts receivable for $1,700 right there. Number 20, on the 27th, Leonard withdrew $650 cash from the practice to pay, personal expenses, debit withdrawals, credit cash, $650. And then on the 30th, it says paid $175 cash for utility bills, debit to utility expense, and then credit to cash for $175. Okay. Then on the 30th, received $2,000 from a client for services to be rendered next year. So in this situation, this is unearned revenue. That's what this is. This is not revenue yet. They got paid up front, but they have not provided the service yet. The revenue recognition principle is an important principle in accounting. It says that you cannot record the revenue until you have earned it, and you have not earned it yet. You will earn the revenue once you perform the services. So you're getting cash up front, so it's a debit to cash, $2,000, but then it's a credit to unearned revenue or unearned fees for $2,000. Okay? All right, so let's go ahead and take a look at the last one that you can do for in this course, in this module. So what you have right here is what I want you to do is prepare an income statement, okay? And prepare the statement of owner's equity and then the balance sheet. If you haven't done that, please take a second to go ahead and do that. Okay? So welcome back. Let's see how you did. So with our first one that we're going to do is we're going to do our income statement. So what we have right here is Smith's Repair Shop income statement for the year ended 12/31. We have our services revenue, all of our expenses, add them all up. We have net income right there. Okay, and I'm pulling all these from this trial balance. So right here, starting down, those are all my income statement accounts. Okay? I can look over here and I can say, all right, I've got my statement of owner's equity right here. So I've got my Smith Capital 39,525, my net income that I did on my income statement gives me my 107,900 less my withdrawals, gives me capital right here, my ending equity of $71,900. Then I can come down here and look at my balance sheet. Okay, so I have my cash, my accounts receivable. I'm pulling all these from the trial balance. Repair shop equipment, service truck gives me total assets $74,500. I have my accounts payable and my liability $71,900. That's where I got that from. Add those two together, the $2,600 plus the $71,900 reconciles to $74,500. And then we check out in our balance sheet balances. Okay. All right. Well, I hope that was helpful. Thank you, and please let me know if you have any questions.